the correlation is broken. We're not buying gold because the dollar is weaker. We're buying gold because we're scared to death of what the hell is going on. And a government shutdown doesn't help that any. We may not buy it as aggressively when the dollar strengthens, but we're not going to sell it anymore.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the Goldfix Market Rundown. We have multiple topics to talk about. The title is Government Shutdown is Here, Gold and Silver Higher. Keep it simple. The three things we'd like to discuss are, in brief, Hong Kong, in September 17th, the mayor, or for lack of a better term, made a really important policy announcement. And we're going to discuss that in the context of gold infrastructure as a bridge to yuan internationalization. Second, and really the headline, is what to expect now that the U.S. government is shut down. We have a post on that, and we're going to give you a little excerpt from it. And finally, what we wanted to focus on today, but reality gets in the way, ETFs are the aggressors now, outbidding sovereigns. And that's a reference to a report by Deutsche Bank. Thank you to Zero Hedge for that. And we broke it down and wrote it up. So without further ado, let's get started. There's the homepage. One quick digression. The Goldfix PM has a premium section, LBMA update. We believe it's extremely important because it's relevant to the path of silver. This is related to the silver squeeze you can buy into that Dan Gali was talking about. So if you're focused on silver, you want to go there first. The other stories we'll get into. 10-year yields are down 1. The dollar is down 4, almost 5. The S&P 500 is 66.60, down 12. The VIX is up. The VIX is up. How do I say this? The VIX is basing at 15 now. So something to be aware of. Gold is 38.81, up 23, near the highs. Silver is 47.32, off the highs, but pretty high itself, up 68. Copper down a penny, crude down 35. Can't get out of its own way, huh? Natural gas up 4, Bitcoin up 2,600. That's the first time we've seen that. I think it was down earlier. Ethereum up 150, Palladium up, down 2, and platinum up 19. Interesting. Gold, silver weaker, and grains are all soft uniformly. They're just getting sold at the same time by some fund. All right, let's just get to the stories. Number one, Hong Kong gold infrastructure as a bridge to yuan internationalization. Now, I've been looking at this, or the progress of China's rollout of its de-dollarization plan, which involves essentially not just getting off of dollars, but getting onto something else. And the store value is gold versus treasuries. But the currency is they need to internationalize the yuan. They have needed to do this, and we've discussed this at the BRICS meetings going back 2 years. You can't get off the dollar unless you have a currency to replace it. And the yuan is not trusted, at least not yet. And the other BRICS wanted it to be more globally used. And the way to get the yuan globally used is gold. On that note, they had to build vaults, they had to expand, they have to attach the yuan or renminbi to the gold, had to get it in everyone's hands, and then they had to start selling stuff. So on that note, I think an important mile marker would be John Lee Ka-chiu, I'm not trying to say his name, John Lee Ka-chiu announcement. So let me just read that. The policy announcements by Chief Executive John Lee, we'll just say that, must be understood as another step in the progression toward BRICS' declared goal of elevating gold's role in the global system. China's ambitions for the yuan hinge not only on wider trade adoption, as I alluded to, but also on embedding credibility through tangible monetary anchors to the yuan. Gold is the logical proxy, and Hong Kong's development as a gold hub positions it as the offshore platform for this transition, along with a couple of other hubs. Now, this is something that we've been studying for a long time. But in the last 6 months, we've been having more conversations with Eric Young, King Kong on X, because we've kind of intersected. I was saying that gold is tier one, and he was saying that it's going to be more. And I understood that HQLA was important in order to internationalize gold, which would allow the yuan to internationalize. And he and I got together and I said HQLA and he said repo. And then we saw the chart that was online and we said, oh, that's it. This is what they're going to do. So HQLA, repo, et cetera, et cetera. Read the story to get the idea. I don't want to bore you too much with that. That whole story is right there, unlocked. Second story, the main story, what to expect now the U.S. government is shut down. With the shutdown underway, expect immediate furloughs for up to 900,000 federal workers and delayed pay across government. Key deadlines emerge around October 15th, military pay and CPI. Each week shaves about 15 basis points from Q4 GDP with a rebound in Q1. Economic data releases, including the October 3rd jobs report, could be delayed, not necessarily will be delayed. Employment metrics risk distortion while markets show limited consistent response. Operational uncertainty, possible RIF notices, and political brinksmanship define the landscape in coming weeks. We have that analysis broken down. It's basically a Q&A that Goldman did before, and we broke it down and framed it as to what to expect going forward. And that is what to expect now the U.S. government is shut down. That was sent out yesterday. Today, we sent out ETFs are the aggressors. That's their word, now outbidding sovereigns. Deutsche Bank's latest special report examines the drivers of gold's rally, focusing on exchange-traded funds, central bank activity, and the price elasticity of different demand categories. That's what's new. ETFs are being more price inelastic. They're buying regardless. The report, authored by Michael Shui, aims to determine which actors function as aggressors in the market and how this translates into price dynamics. They're trying to frame it this way. Aggressors are buyers or sellers no matter what. And they don't call them passers or passive, but passive players are reactors. I'm going to give it to you in a framework that we've discussed here a million times. Market makers and market takers. Market makers react to you. You say you want to buy it, they sell it. That's a bullion bank, right? That's or central bank when they buy it underneath. Market takers say, I'm buying it, it's going up, and they lift the offer, right? They drive price. Market makers determine limits to movements, and market takers determine direction within those limits. So traditionally, ETF buyers are high beta market. They're passive. They're market takers, but they're usually very patient. So ETF buyers are, I'm an investor. I want to buy gold. When the dollar's down, I'll buy it. When the dollar's up, I sell it. So they kind of trade the range in a passive way, even though they're market takers. But what they've noticed, or what the bank has noticed, is that, and you've all seen this, we've been talking about it for years, that these passive buyers are buying even when the dollar is strong. These passive buyers are buying even when bonds are up. So it's you may be sitting here as a gold bug saying, yeah, no kidding, But understand that this is a purely statistical analysis saying your intuition is right. Even the ETF buyers are no longer saying, oh, they're not neo-Keynesian anymore. I'm anti-neo-Keynesian lately. But that's the key. The key is ETF buyers are now competing with central bank buyers who are already ignoring the dollar. So that's going to make things a little bit more bizarre going forward. The question is, as a trader, the question is, well, will they be more aggressive selling it on the way down? And I'm telling you the answer is no, they will not. And they will sell it or they will back off on buying it, but they will not be more aggressive selling it because the correlation is broken. We're not buying gold because the dollar is weaker. We're buying gold because we're scared to death of what the hell is going on. And a government shutdown doesn't help that any. We may not buy it as aggressively when the dollar strengthens, but we're not going to sell it anymore. That money we take out of Mag 7, it's staying out of Mag 7. It's going into mining stocks. It's going into materials companies. It's going to GLD. It's going into SLV. That all continues in bank ETFs. Are aggressors now outbidding sovereigns. It's great confirmation of what we've intuitively known. It's also a sign of the spreading of the correlation breakdown, right? Correlation breakdown. Banks don't care. BRICS don't care. I just want the gold. I want the gold. Well, now ETFs want the gold. Yeah, there's your title. Okay. Next, related post, Goldfix PM LBMA update. I mentioned why that's important. That Goldfix LBMA update is important in context of what Dan Gali said several months ago. Silver endgame approaches. It's the slow silver squeeze that you could buy into. Meaning short squeezes really aren't something that you're supposed to see coming. And he's saying this is coming. And we think that if the LBMA doesn't get there, if the LBMA drawdowns continue, and that'll be because the ETF demands continue, then the free float in the LBMA will go to zero. And when it goes to zero, they will need to borrow to lease metal from someone. If they do not, you're going to have a problem in the ETF world. And the ETF world will start draining, say, the COMEX vaults. And that'll start draining when the metal starts rallying. That's it. So LBMA needs someone. LBMA has a pan out, and they're asking people to lease them metal. Buffett, do you have any metal to lease? Nope. Then they're going to start going to nations. And India, they got some metal. Maybe they'll lease it at the right price. China, they could too. Who knows? But we're running out of breathing room here. And according to Dan, it's at the current rate, it's 3 months, maybe less. Moving on. The chat, I'll get to it today. I'm going to divide this up. I know it's been a little bit unwieldy, but that's libertarian to me. Today is PMIs, which are important, but I think they're going to be overshadowed by whatever the hell else is going on. And Friday is unemployment. A reminder, I will be out tomorrow and Friday, but I will be unlocking a previously premium voice note or video for people. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.